Okay, well, in Chapter 20 we looked at some of the economic influences on investment markets. We're going to look now at some other factors that also influence investment markets, primarily supply factors and demand factors. So let's start off with looking at demand factors. The demand for a particular asset will change as a result of changes in the perceptions of investors of the risk and return characteristics of an asset. If they perceive that it's more risky and that the return doesn't reflect that risk, then obviously they will move out of that particular asset and the demand will fall. But it can also be influenced by external factors such as the level of investors' income, investors' preferences for different types of assets, and also the price of alternative investments. So in particular, the amount of money that's available for investment by institutional investors can have a significant effect on market prices, and this is largely a reflection of the level of savings in the economy. In times of when the economy is doing well, people will save more money in the form of pensions and endowments and so on, and that money obviously has to be invested somewhere. But also it will depend to some extent on the relative preference for different savings vehicles. So whether they go for things like endowment assurances, whether they save in pension funds, whether they are looking more at ISA type investments, these kind of things. So the demand for the investments will depend to some extent on how much money is being saved in the economy. Let's think about investors' preferences for different asset classes, and these can change as a result of a change in their liabilities. We've talked in the past about the fact that one of the key requirements for institutional investors is to invest in assets that match the nature and the term and the currency of their liabilities. So if the nature or the term or the currency of their liabilities changes, then the type of assets that investors are looking to buy to match these will also change. And an example of that really was the increased demand for index-linked bonds as a result of high inflation in the 1970s and 80s when institutional investors who had liabilities that were linked to inflation, so for example pension funds and insurance companies, life insurance companies in particular, they were looking for assets that would match inflation when inflation was particularly high, and therefore they preferred index-linked bonds as opposed to fixed interest bonds, and that's really where the market for index-linked bonds came from. But other factors that can influence the demand are really changes in regulation or taxation. So an example of a regulatory change might be that the government or the insurance regulator changes the rules and requires a proportion of an investor's funds to be invested in government bonds. So they will say specifically that for example 50% of the funds must be invested in government bonds. If that's the case, then clearly the demand for government bonds would increase. A slightly more indirect way of doing that is to specify the way that the statutory liabilities are calculated. So rather than force insurance companies to invest in for example government bonds, you encourage them by saying that the statutory liabilities, the way that they prove whether they're solvent or not, these statutory liabilities will be calculated with reference to the yields on government bonds, and therefore there's an encouragement to invest in government bonds because that matches your assets and your statutory liabilities. But there's no compulsion to do so. You're not required to. It's just an encouragement. But either of these changes would likely lead to a rise in the demand for government bonds. Similarly, on the taxation side, if the taxation system changes such that that investors are taxed more on income than capital gains, then it'd be natural for investors to prefer growth investments that have a low running yield, a low level of income, and therefore a correspondingly higher level of growth, where they ultimately will pay less tax overall. So that would encourage a preference for equities, for example, over fixed interest bonds. So changes in the taxation system can change the relative attractiveness of different asset classes. Other things that can affect investors' preferences, the political climate, the demand for assets will tend to fall if political instability increases. People will take their money out of a whole range of asset classes and wait and see what happens, and that very often happens before elections. In a lot of countries, markets tend to fall as people take their money out and wait and see what happens, and then if there's an unexpected result in the election, frequently again there can be a fall in the value of investment markets as investors try to decide what the impact will be. And during those periods of uncertainty, you'll tend to find that demand for safe assets, particularly things like gold, tends to rise. So the price of gold had increased dramatically since the credit crunch in 2008. Investors were fleeing from more established assets, things like equities and government bonds and so on, for various reasons. Equities because of the economic uncertainty, government bonds because the yields on them were very, very low, and as a result they were buying up more and more gold as a safe investment, and the price rose considerably. And then I suppose the final factor that can affect the investors' preferences and for demanding different kinds of assets is really marketing and education. As new types of investments are developed and investors understand them better and understand better how those investments can meet their needs, then it's natural that the demand for these assets will rise. Took a while for the derivative market to take off. Institutional investors in the 1970s and 80s didn't really understand how derivatives worked, particularly over-the-counter derivatives. So it took a while for these assets to become popular, but now they're very, very important to most institutional investors. And then I suppose the final point to say really on the demand side is that to some extent or other, all investments are substitute goods. You invest either in bonds or in equities or in property or in cash or whatever. So to that extent there's a strong element of correlation between the price of different asset classes. To some extent, when the price of one goes down, the price of another goes up, because investors are simply substituting one asset for another. So as an example, if we think of a close substitute for property investments, if investors decided that they wanted to move out of the property market because perhaps there was some new regulation that was going to adversely affect them, or there was uncertainty about some of the planning regulations and how that might impact on the property market, then what would be the closest substitute for a property investment? Well, probably in truth an ordinary share, because in that case both of the assets are real assets. The value of the income can be expected to increase over time. Rents can be expected to increase over time as corporate profitability rises, and also dividends from shares can be expected to increase over time, again through the increase in corporate profitability. But that said, if it's a property investment that has very, very infrequent rent reviews, then the rent will be fixed for very long periods of time, and in that case you might see the property investment as more similar to a fixed interest bond than to an equity. Okay, well that's the demand side. We can also think about how supply factors can influence investment markets. So an increase in the supply of equities, for example, would put a downward pressure on share prices. Why might there be an increase in the supply of equities? Well, the main reason really would be rights issues. Existing listed companies are issuing more shares to try and raise additional finance, and this tends to happen either when markets are very, very buoyant and therefore investors are feeling good about the prospects of the economy and the company in general, and therefore they might be happier to invest more money, or conversely when during a recession when balance sheets are very weak and the company needs to raise additional finance to help it continue its operations, they'll frequently ask investors for money. Clearly in that circumstance they're less likely to get it because investors are less positive about the outlooks, but there are rights issues in both of these situations. There can also be an increase in the supply of equities due to privatisation of nationalised companies. Certainly in the UK in the last 20 or 30 years, a number of nationalised industries have been privatised: the gas industry, the water industry, the rail companies, and so on. And there can also be initial public offerings by existing companies that want to become listed on the stock exchange. And again, these things tend to happen more frequently when the economy is buoyant, when equity markets are doing well, and therefore you're likely to maximise the income that you're going to receive from selling the shares. However, that said, in practice, changes in supply as a result of these kind of factors are likely to be relatively small compared to the overall size of the equity market. So it's unlikely that changes in the level of supply will have a significant effect on the overall level of the market as a whole. Similarly, if we look at the bond market, then again an increase in the supply of bonds clearly puts a downward pressure on prices. The supply of bonds is largely dependent on two things really: the size of government borrowing, their fiscal deficit, and the strategy that they use to finance that deficit. Primarily they will tend to finance it by issuing bonds, but there are other ways that they might choose to finance it. They could issue shorter term treasury bills to finance the deficit. They could increase taxation to try and cover the deficit that way. They could print money even if they wanted to do that, or they could sell off existing government assets, so land, property, and currently state-owned nationalised industries. So it depends to some extent not just on the level of the government borrowing, but also how they choose to finance that deficit. And finally then, if we look at the corporate bond market, then in some ways this is similar to the equity market. Corporate borrowers or companies will tend to issue corporate bonds when the bond market is performing well, when yields are low and therefore the price of bonds is high, and in that case the interest payments that they're likely to be required to make on these newly issued corporate bonds are likely to be minimised. So again, when the markets are doing well, that's when you tend to find more of an increase in the supply of these assets. Although that said, as with equities, when companies are performing badly and the economy is in a recession, that might be the time when companies need more funds, so they might like to try and increase the supply. So in practice then, the supply of government bonds will tend to rise during a recession when the government's deficit rises, because they're likely to bring in less money from taxation and they may be paying out more money in the form of benefits and so on. But the supply of corporate bonds, conversely, probably will be more likely to rise when the economy is doing well, and therefore it's relatively cheap for companies to issue more debt, and the interest payments on them are minimised. So we'll stop there.